will find the link to Bitcoin Basics crash course in the description and pinned in comments below. Institutions are quietly moving billions into Bitcoin, and it's changing who wins and who loses. What they know that most beginners don't will decide whether you survive the next bull run. In this video, you will learn 3 hidden reasons institutions prefer Bitcoin. You will also learn one dangerous mistake most beginners make during capital rotation. And you will get a simple decision rule to protect gains and ride the next big wave. Stay with me until the third reason. It flips everything you thought about crypto investing. If you want clear, no BS crypto lessons for beginners, subscribe now. I post deep practical breakdowns every week to help beginners avoid costly mistakes. Most people think institutions buy crypto for quick profits. That's wrong. Understanding why institutions enter reveals where future money will flow. Institutions chase 3 things: scale, custody, regulatory clarity. Scale matters because institutions need assets that can absorb billions without instantly spiking the market. Custody matters because the safety of client money is non-negotiable. Regulatory clarity matters because fiduciaries cannot gamble with vague legal risk. Bitcoin checks those boxes in ways most altcoins do not. Think of Bitcoin as a blue chip skyscraper while many altcoins are pop-up shops. Institutions want durable buildings, but there's one structural feature of Bitcoin that makes institutions nervous and greedy at the same time. I'll explain that next. Something most beginners miss is the supply side of Bitcoin. It is quietly shrinking. That scarcity is reshaping who controls price. Bitcoin has a capped supply of 21 million. Combine that with long-term holders, lost coins, and institutional treasuries, and the available float for trading is much smaller than you would expect. When demand spikes and float is limited, even modest institutional buying can move prices aggressively. MicroStrategy and Tesla treasuries are examples of institutional holdings that reduce liquid supply. Exchange withdrawals to cold storage also remove coins from the market. Fewer sellers means higher price pressure. This is why small buys by institutions can trigger retail fear of missing out. If you ignore this, you risk holding assets institutions will never touch. That means lower long-term demand and more price volatility. Next, I'll show the single institutional behavior that usually predicts the start of a massive rotation out of altcoins. Capital rotation sounds fancy, but it is the market's quiet heartbeat. Miss this and you will sell the wrong thing at the worst time. Capital rotation is simply money moving from one asset class to another. During bull runs, profits are taken from riskier bets and parked in perceived safe havens. Institutions rotate capital based on liquidity risk controls and macro signals. Imagine a hedge fund that made 10 times on a small cap alt. They will take profits and park them in Bitcoin or cash while they reassess. That profit taking pushes alt prices down and pumps Bitcoin. It is like a crowd at a concert slowly shifting closer to the stage when the headline act arrives. Most beginners get caught on the slide down, not the climb. If you hold only altcoins without a plan, one institutional rotation can erase months of gains overnight. But how do institutions decide when to rotate? There is a signal they watch, and I will show it next. Institutions monitor a small set of signals. One of those signals almost always precedes large flows into Bitcoin. 10 top signals include macro liquidity, ETF filings, and approvals, custody, onboarding, and on-chain flows of exchanges. Macro liquidity means interest rate moves and central bank policy. ETF filings and approvals reduce legal friction and open retail and institutional channels simultaneously. Custody onboarding lets institutions meet compliance checkboxes. On-chain flows like large withdrawals from exchanges to cold storage often indicate accumulation. When a major custodian announces support, institutions can finally onboard client money at scale. Missing these signals is like watching the tide come in while you continue to sunbathe on the sand. Next, I'll show how to read on-chain flows in simple steps with no technical background required. Here is a simple 3-step rule institutions use and you can do to protect gains during rotation. Rule 1. Monitor exchange flow. Big withdrawals to cold storage often mean institutions are accumulating. Rule 2. Use layered exits. Do not sell everything at once. Sell slices into strength. Rule 3. Keep a core position. Treat it like an institutional treasury allocation, a percentage you rarely touch. If you made 100% gain on an alt, consider selling 30% into Bitcoin or stable coins. Keep 50% at core. Let 20% ride. Adjust the split to your risk profile. This rule prevents panic selling and keeps you exposed to upside if institutions keep buying. Most beginners misuse stop losses here and that mistake compounds. I will expose the error and how to fix it next. The biggest mistake is not buying top too late. It is selling at the worst time because of a poorly placed stop. Stop losses placed close to volatile support levels get hunted during rotation. Institutions and algos can trigger them, creating cascades. Instead, use volatility adjusted stops or time-based sells. Combine these with layered exit rule. If Bitcoin swings 6 to 8% daily, a 3% stop is suicidal. Place stops outside normal volatility or use scheduled sells. This mistake turns smart trades into catastrophic losses overnight. There is one mental rule that fixes almost every beginner error and I will share it next. Forget charts for a second. This one mindset separates long-term winners from noise traders. Adopt the position first mindset. Decide your core allocation before you enter a trade. Plan your exits before you buy. Treat volatility as a feature, not a bug. Institutions plan allocations, not trades. Replicate that with small capital and discipline. Write your allocation plan with percentages for core Bitcoin, swing, alts, and cash. Rebalance quarterly. This reduces fear and makes your decisions predictable. That is the opposite of what social media trading encourages. Now, the biggest insight ties scarcity, rotation, and signals together. The real reason institutions buy Bitcoin is that it acts as a scalable, auditable, and regulatory safe store of value. It lets them manage portfolio liquidity during market cycles, combine shrinking float with institutional infrastructure, and you get sharper, longer lasting bull runs. That means patient, planful holders and anyone using layered exits stand to benefit most. If you switch from reactive trading to planning, you stop being prey and start being part of the market structure that benefits from institutional flows. Scarcity plus infrastructure equals institutional demand. If this helped you see how institutions shape Bitcoin's price, subscribe now for more beginner first breakdowns. I make step-by-step guides so you do not have to learn the hard way. Before you invest in any coin, watch the next video where I teach beginner investing frameworks and wealth building habits. It will give you the exact allocation templates I use and teach you how to rebalance without panic. Click the next video now. Remember, institutions do not trade on hype. They build systems. I learn the system and you change your odds.